The US share market is dropping, and may I suggest that right now is not the time to panic. Hello and welcome to this week's US stock market report. I'm Gillham, the chief analyst here at Wealth Within, and today I'll be discussing a very hot topic, the current US stock market decline. Today I'll be covering the Dow Jones, the S&P and the US market as a whole. Now I'm sure many of you have been left feeling confused and don't understand what's happening in the US market or why. To date, there's not been a lot of transparency around the US market, so I'm here to help explain to you what's happening, why it's happening, and what you can do about it for yourself. Now, important thing to note is that it's just a market pullback and there's absolutely no need to panic and make rash decisions. This pullback is quite normal and something that happens regularly. More importantly, what may surprise you is it is predictable in many ways. Let me say once again, for your success in the market, it is important to not let the noise get to you and cause you to panic and make emotional decisions. Right now, the US market is falling heavily and there's doom and gloom surrounding this fall. One of the most important things I'd like to share with you about investing or trading is that there are always signposts that alert you to what may happen before it happens. In a minute, I will share with you my thoughts on the US market and how you could have been prepared for exactly what is happening now. You may be asking yourself right now, how can you tell what's going to happen when it comes to the stock market? Well, as it turns out, it's quite easy and, dare I say, much simpler than you think. By around mid-year, I will be releasing a new book in the US that will show just how, with a rule on a pencil, you can avoid the pitfalls of the market and build a more powerful portfolio. So subscribe to this channel to keep informed of that. Before I get into my take on the market, I want to share with you some insights into human behavior. When it comes to investing wisely, there are times to buy and there are times to sell. And we are seeing this play out right now in world markets. Here, many investors ignore simple philosophy and end up paying the price of costly mistakes, which, as I alluded to with some simple rules, can be avoided. In my experience, it is common for investors to follow mass opinion or follow the herd, as it's known in investing circles. Following the herd is a sure way to do poorly with your investing and trading. This is simply because amateurs tend en masse to buy at the top of the market while the professionals buy at the bottom. Pretty simply, really. But how do you know a top or a bottom is coming if you're not a professional? Well, that is where you need to read the signposts that I mentioned. If the amateurs tend to buy at the top, this means the herd is getting into something en masse. When this happens, then you know the end is not too far away. I will share with you what I mean on the charts of the Dow Jones in a minute. The herd tend to buy because they've read a report and somehow connect this to absolute fact. They may have been on chat forums listening to others from the herd talking up an investment or market. Many perceive that if someone has credentials or is portraying themselves as an authority on a subject, that what they state must be true. But is this really? In my opinion, all that glitters is not always gold. Another big mistake investors make is lack of awareness of how a market, stocks or commodities unfold. Markets do not crash at the top, and history indicates that the biggest falls occur towards the end of a decline. So why is that? Well, sadly, this is when most investors can no longer stand the pain of losing and decide to sell. Remember, the amateurs buy at the top of the market. Well, they also sell at the bottom too. Again, why is that? Well, simply because they fail to understand or manage their risk properly. These are signposts. When everyone is talking the market up and getting into it, then the end is close. If everyone is fearful of the market and staying away, then the time is to buy, as the market will likely start to rise again soon. Pretty simple, really, and no PhD necessary. Successful investing and trading is about having a solid plan. It's also very common for me to find out that when talking to the majority investors and traders that they do not have a risk strategy at all. When teaching them about how to be successful in the market, managing risk is my number one topic. Now, I constantly emphasize the importance of proper position sizing, setting exit strategies such as stop losses. In my earlier book, How to Beat the Managed Funds by 20%, I recommended that investors set a stop loss at around 10 to 15% of the buy price. If a stock you purchase falls below this level, then you would exit. The sad fact is that the majority of investors struggle greatly with selling at a loss, and this is the number one reason why they achieve poor returns. Not selling always comes with the investor misleading themselves with sayings such as, if they have not sold, then they have not lost, or I will sell when it comes back to what I paid for it. The list of reasons, or should I say excuses, that I hear in order to validate poor strategy are endless, and all lead to investors losing more time, more money, and lost opportunity. Let me say, when your investment is in a loss and you do not have the knowledge to know what to do and when to do it, then it does not matter what the opinion of the crowd says. The reality is that your investment is worth less than you paid for it, and so you have lost. The quicker you realize that having losses is part of investing, the better off you will be. And the sooner you will realize that following a herd is a sure way to mediocre returns, and the better your returns will be. Well, what do I expect in the US market? Well, let's get into the charts and I'll share with you just how easy it is to see that the market was due for a fall. On your screen right now, you'll see a monthly chart of the Dow Jones Index. And what you'll see right up the top left-hand side is you'll see that there I've got date going back to 1900, although I'm showing on the chart only from about 1984 through to the current period. And I have studied the Dow Jones right back to that 1900 in its terms of its price and its time cycles, so I really do understand what it's doing, how it unfolds, and where it's going to. What I wanted to do today was to really just show you a simple method using a rule and a pencil, how you can understand when the market is starting to peak out, and also when you might like to, or when you can find out when it's bottoming in as well. So I'm going to take you back to the period between the 1987 crash and that 2000-2001 high in the market, and I'll show you that. Let's just zoom the chart up a little bit so you can see it a little bit more clearly. So I'll get rid of the later data there, and you can see how I've got some green lines on this chart. Now these green lines, I've just used a trend line tool, and you can do that on a lot of platforms and a lot of software that you've got. It's a pretty common tool, and this is where your ruler and a pencil comes into it. And I find this is a hugely valuable tool, using a trend line, because a trend line shows you the rate in change of price over a period of time, or in other words, it shows you the momentum of the market, and markets have their own momentum. So you can see here how I've got a green line going out from the bottom of the 87 crash, where you can see here the Dow Jones hit a low of 1,616.21 points. Now I've got a green line going out there on that angle, then I've got a second one, a third one, and then a fourth one going right up into that top in January 2000, prior to the market pulling back down into late 2002. And as you saw there, the Dow Jones hit 11,750 points in a very, very good bullish run. Now, here's the trick with these lines. 1, 2, 3, 4 lines. Generally, once you see the third angle change, the top is starting to come. I don't see more than 5. Generally 4 pulls it up, but I don't see more than 5. So what that is when you just grab your ruler and a pencil out, shove it on a chart and start drawing these lines on a monthly chart, you'll actually see when the market's going to run out of steam or run out of momentum and is likely to fall. This same theory works on stocks as well. So it doesn't matter whether you're looking at a market or an index or a stock, it will work. Now let's go to the current movement from the bottom of the GFC. We can see here that the bottom of the GFC here is in March 2009. Now, I've drawn one basic trend line right through to the lows in 2016, a second one, a third one. So the market is increasing in speed. Now, I could have drawn a couple of others in here, like this one through here, because the market did pick up speed right through here. So we've had 3 or 4 of these. Now, at this point in time, the market does need to retrace. It is going at a pretty solid speed at this point in time. Now, if I look at this in comparison, I can drag this line over here and see the first run from 2009 was roughly at the same speed as the move from about 2012 to about 2015. But if we move that over here, you can see the current move is going at a lot faster pace. And when something goes at a lot faster pace, then it does need to come back and correct a bit. That's why I do have this other line on here, so I'm thinking the market is coming down there. Now what I've also got on this chart is the movement from the low in March 2009 through to the recent high of last month, where the Dow hit 26,616 points. You can see here what I've done is these green figures here are really what we call a price retracement of that range. Some people call them Fibonacci numbers, but basically I've measured that range from the low to the high, and I'm saying how far is it likely to fall. So my period, or my target period here, is 21,580 points to 18,920 points for this move down. Now currently, if I put my nice little tool on here and I just check, so we can see here that currently to that low, there was a 10.6% fall currently at this month. Now while it's closing a bit higher than that, it hasn't fully lost 10.6%, but it is something from our point of view is the market is still falling, and I would expect to fall somewhere in around 20 to 20%, that sort of 20% mark. Normal markets will fall somewhere between 8 and 12% every year at one stage, and about every 4 years they'll fall a little bit more, like 15 to 20%, or every 8 or 9 years will fall about 15% in that respect. So I'm expecting a larger fall at this time of around about 20%. It could go a little bit further, but at this point in time I'm looking at around that sort of 21,500 point level. One of the couple of other things you might actually see on this chart here is, if we go and look back here, is we can see it is looking very, very steep in terms of how far it is actually falling. Now I'm going to take off all those lines for you so you can actually see what I've been doing. I'm going to take off all the prices here, and I'm going to put on a couple of other tools that will help you understand where the market is going. So what I've done here, if I get rid of this, you'll see how the move from the low in 87 through to the high in January 2000, before the pullback into 2002. You can see here it says 147 bars where my pointer is. That is 147 months. Okay, from the low in the GFC, so we're looking at in March 2009 to the current date, you can see there's 108 bars from that move. And so what I'm expecting is the market will actually start to find a peak soon if it hasn't already found it. Now this is quite fuzzy in terms of you don't get exactly 100 days or 100 months or 100 years. It's a little bit fuzzy, but it's saying that the market is due to get a peak quite soon if we understand how long markets do rise. Now let's go back to 1929, because a lot of conjecture in the market at the moment comparing the move now, or that the market will have another 1929 crash. And you can see here where my pointer is right now. The market in September 1929 was 386.1 points, and then the big fall into that. So let me just show you the run up into that, and if I can find what I've actually done with them. And let me just put that on there anyway for you. I'll just do it manually for you. If I go to this low here prior to that, and we run it right out to the high here, and I'll just drag this down so you can see it. You can see here that was 97 months from the low back in 1921, in August 1921, and it had 197 months before the fall. So around that 100 months tends to be looking like the market could be peaky. This is some of the stuff I do and I teach our students to do in terms of understanding the marketplace, how far likely a market is to rise or fall. Because remember, markets go from low to high to low again. They just don't continually go up forever. Let's just have a quick look now at the S&P. I'll just go back to the Dow, but I'll go back to the S&P 500, which is obviously the other major index in the US market. And you can see here how it's risen from the 87 low. What I've done here from the 1987 crash to the previous all-time high back in November 2007 prior to the GFC, I've measured that range and extended it off the low here from March 2009. You can see there, March 2009. And you can see how it has risen up to 161.8% price extension of that prior range. So I've added the prior range from 87 to 2000 onto the low in March 2009. That's just one of those points where I'm thinking, yes, the market will find some resistance and start to fall. We can do that on the same type of thing on the Dow Jones. So if we go to the Dow Jones, let me take off these points here, and I go and put on some price extensions. Now, what I've done is, let me just scroll this up so you can actually see a little bit better. I've done exactly the same range, 87 to 2000. Then we drag that down, and again, you can see 26,827 points is 161.8% of that range as well. So it's quite similar. I can put on some other ranges. As you can see here, there's another range. And what I've done here is done another price extension of a different range, so that you can see here we're getting a confluence of our price analysis suggesting that the market is going to find some resistance and turn around. That said, from what I mentioned before, I'll just take those off so you can see the chart a little bit easier, is we are expecting the market to pull back a little bit. It's not uncommon what we're seeing right now. It is roughly a 9 or 10 year move down in the Dow Jones. I just think it's about a rebalancing of that market back to its normal speed. And so it's nothing too much to be panicked with. That said, as I mentioned in my report, you really do need to set stop losses or have risk management on your portfolio. So if you're not sure how to do that, maybe you should come and visit our website, and I'll talk to you about it on some of our podcasts on Soundcloud and some of our blog posts, that sort of stuff. We talk about those sorts of things. But hopefully you've enjoyed this market report for the Dow Jones Index and the US market. What are your thoughts on the US market? If you've got any questions, comment below. If you've enjoyed our report on the US stock market and you'd like to see more videos, subscribe to keep up to date. We'll be releasing more US market videos weekly, so keep an eye out for those. If you'd like to listen to more of our content, go ahead and listen to our Talking Wealth podcast, available on Soundcloud and on our website. They're jam-packed with valuable information that's great to listen to. Are you interested in learning how to trade the stock market? Learn from Australia's only government accredited stock trading educator how to properly trade the stock market. So whether you're a beginner or a novice trader, we have a solution for you. Click the first link in the video description below to find out more about our courses. Thanks very much for watching this video. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.